You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host. As always, we're in the middle of January and the market is smashing on already. I wanted to spend this morning without a guest with a number of updates for you, observations on the market about how things have gone historically over the last few years in Perth. Take note of some of the massive growth we've seen over the last 5 years. Have a look into the immediate future as to what's happening with interest rates, and have a bit of a chat around what our key risk factors look like going into 2026. The first thing I wanted to talk about, the most immediate thing, is probably the talking point that will be coming up over the next couple of weeks, and that is interest rates. We probably didn't expect to be having a conversation, I think, about rate rises. If you asked us 6 months ago, are we going to be talking about rate rises or rate drops at the start of 2026? I'd say 95% of people would be on the rate drop side, but it's also not surprising, given the amount of money that continues to wash through the consumer side of our country, that the RBA is getting a bit nervous about us hovering just above our target range of 2 to 3% on our inflation numbers. And so I think it's important to get ahead of the conversation before you start hearing the noise, the fear-mongering on the news and with the pundits about what this means and whether it may or may not happen. My bet is there is a higher likelihood that in 2026 we will probably see a rate rise. There is a smaller likelihood we will see 2 rate rises. Does that mean that we will also not see at the end of the year, as if things cool in the CPI inflation space, that's consumer spending really, that it wouldn't start dropping again? No, it doesn't mean that wouldn't happen. But in terms of the immediacy, the data we can see at the moment, there's actually a good chance that we will see a rate rise on the 3rd of February. So I'd like everyone listening to not be that surprised if that happens. And I quickly want to run through how that may happen. So the RBA is always looking at indicating data coming through. It really cares about inflation and unemployment. Those are the only 2 things it has a remit to care about, to be honest. Now, what it wants to see generally is unemployment being around 4.5%, something like that. And it's funny how sometimes they can suggest too many people have a job. Unemployment's too low, as if it's a bad thing to have people employed and less people homeless. But the reality is, with regards to their markers of keeping the economy as stable as possible, they actually want a certain amount of people not employed, which sounds counterintuitive, but it is the reality. What we want to first off see, we have on the 22nd of January, that's this week, we have the quarterly unemployment numbers coming out. Now, if any of the 3 markers I'm about to tell you come in an unsavory way, and I'll mention them in a second, that the RBA want to see, that will be individually, each and every one of them, a trigger for them to probably raise rates. And it's a pretty small chance, in my opinion, that will see it stay on hold from an arbitrary perspective based on the numbers, because any of these 3 being not where it needs to be probably gets them across the line, in my opinion. So unemployment numbers coming out this Thursday. If the number comes out at 4.4% or lower, that's, in their opinion, too tight an unemployment market. That would be a trigger for them to increase interest rates on the 3rd of Feb. Next week, on the 28th of January, the quarterly inflation numbers come out. They'll be looking for a trimmed mean number of above 3.2%. If it's more than 3.2%, bang, we will definitely be getting an interest rate rise on the 3rd of February. If it comes out at 3.2, 3.1, it's better news, but still keeps the rate rise conversation into March and May on the table. The third one is the Producer Prices Index. Now, that's an index of essentially costs going into production of manufacturing goods. If there's any jump in the quarterly numbers there, which is like a leading indicator, if it costs more for a business to make things, they're probably going to pass those costs on, especially in a tight market of demand, then they'll use that as a leading indicator to say, we're going to get ahead of the game here. That comes out on the 30th, next Friday. So it's a big 2 weeks ahead, including the 3rd of February, tomorrow fortnight, that will impact what happens with the conversation. Now, the next question is, does that impact Perth's market, or how does it impact Perth's market? I guess the saving grace for those who have property is to recognise that unless we're hitting affordability caps from a lending perspective, which we are not in Perth, we are in Sydney and to an extent Adelaide as well, what interest rate changes do is they either dampen or accelerate the fundamental growth direction of demand and supply in the first place. So right now we are in the most undersupplied situation we've been in history in Western Australia, fundamentally, on the amount of properties available on the market being created versus the amount of people who are demanding them from immigration, essentially. And what that means is, obviously, we're in a direction of undersupply and therefore price growth. If we see rates rise, that would slightly dampen the optimal or the total price growth we would see arbitrarily out of this demand-supply relationship. And every time rates rise, that dampens that acceleration in price growth by $15,000. That's about the lending amount. And the opposite, if the market was currently oversupplied and rates were to increase, it would accelerate that negative price space by 15 grand arbitrarily. Or if rates were to decrease, which is often more likely in that situation, then it would start to reduce the pain of negative price growth in that situation. The price growth would still happen because we're still undersupplied, but it will be less excessive because people would have more access to debt if they wanted it. How does that affect our markets? When you think about Sydney, always at the moment capping out on their affordability, they're spending about 55% of their income on their mortgage. They are arbitrarily, historically, capped out in terms of what they can afford with their income versus what they're paying for the same houses as us. That means that any time there is an up or down in inflation and interest rates, it has a direct impact on house prices because they're just always hitting red line on the revs on the car, if you want to talk that way. Melbourne's pretty similar. Their income is lower than us. They've got some shocking demand-supply situations going on too, along with the economy generally, taxation generally, malaise of the state generally. Another negative conversation doesn't help them too. It's a bit of a kick in the nuts as they are really chuffing along the bottom trying to find some green shoots in that market. Brisbane and Adelaide, a bit of a similar conversation with Sydney. It starts to get pretty expensive for them. They're the arbitrarily most unaffordable market outside of Sydney, so they've got similar dynamics there, given their income is lower than ours and that median house price is essentially the same as ours. Brisbane has similar headwinds to us, which is positive for them, and it will act as a dampener on rises this year. So that's how our spending is impacting inflation, which will impact the interest rate conversation, and is impacting that conversation at the moment. Let's hope, fingers crossed, it doesn't turn out to be a rate rise, but I want everyone to be prepared for the possibility it very well could, given those indicators coming out in the next 2 weeks, which then impacts, as I said, median house price growth going into 2026. So again, very possible, and you could say likely, we will see a rate rise either in Feb or March. Somewhat possible we see two. Don't let that dampen your spirits, though. In Western Australia, the market is that knackered in terms of being undersupplied that all it does is make it slightly harder for people to pay what they have to. It does not change the dynamics created by demand and supply sides. Let's move on to the next part of the conversation I wanted to have, which is a little bit of a retrospective on where things have gone over the last 5 years in our market with regards to some of our suburb pricing. Now, we have, depending on where you draw the lines, about 220 suburbs in residential Perth, in Greater Perth, depending on where you draw those lines, residential suburbs, that is. And of those, we now have 86 suburbs that are in the $1 million space. 19 south of the river, 16 in the western suburbs, 15 in the inner city area, 12 in the coastal north, 10 in the middle ring north, 8 in the hills, and 6 on the south coast area. 86 suburbs out of 220 are now in the $1 million space. I bet you'll fall off your chair when you hear that only 10 of them were in the $1 million space 5 years ago. That's right. In 2021, the original club of the $1 million suburbs list only had 10 suburbs. That was Peppy Grove, Dalkeith, Cottesloe, City Beach, Nedlands, Swanbourne, Applecross, Floreat, South Perth, and Adderall. It's crazy to think that along that last 5 years, 76 more suburbs have come in from the hundreds of thousands of dollars space and moved themselves into the low to mid $1 millions over that time. And that has just become the reality for Western Australia now, that about 40% of the market has a median house price of $1 million, which is pretty much reflected in the fact that our median house price across Perth is getting closer to $900,000 every single day. Now, of those 86 suburbs, I wanted to point out a few that have just blown my mind personally, to be honest. And there's some great correlations here as well. First thing I wanted to note that nearly all of these have a vacancy rate of 0.5% or less, and that's obvious. If the sales market is tight. The rental market's going to be just as tight as well. But some of these suburbs 5 years ago, closer to $500,000 than $1 million, let alone where they sit today. You wouldn't be surprised to know that Bayswater sat at a house price of $605,000 5 years ago. But you might be surprised to know that it's grown 72% and is now at $1.04 million. Bedford, the same, 650 to 1.12, 70% again. Another one, Rivervale, $560,000 has just tipped over the $1 million space. It's grown 80% in the last 5 years to $1,010,000. Suburbs such as Lathlane, Kensington and Burswood sit in there as well. You might be really surprised to know that suburbs such as Greenwood have just tipped across the $1 million space. Greenwood has grown 84% from a median house price of $545,000 to $1,005,000. Their vacancy rate is only 0.3% with a days on market of 8 days. They're one of the tightest markets in Western Australia. Warwick's done exactly the same when I look at the numbers there. You go down the list and I really start to fall off my chair when I see places like Lesmurdy going from 650 to $1,020,000, Roleystone 640 to $1,005,000. They've only grown 56%. They've actually underperformed the market. The best performing suburb in this $1 million space has actually been Hillary's. Hillary's has grown 87.5% from $880,000 to $1.65 million over the last 5 years, with a days on market of only 11. But let me expand that even further if I start to look at where things sat overall. The middle ring north, if I can call it that, that's grown at an average of 76%. With the best performing suburb in that area being Warwick. The inner city space has grown 60%, so underperforming the market, the inner city space. Now that includes suburbs like your South Perth, North Perth, Mount Lawley, Menora, Bayswater, Maylands. I wonder if that's simply because there's a high level of apartments and units in there in that space and that hasn't kicked yet. We do forecast, based on affordability, that space to kick this year. The winners there, as I said, Bayswater, Bedford, but the winner there, Rivervale at 80% with a $560,000 to $1.01 million growth over that time. Let's move south of the river and look at suburbs like Bicton, Willerton, Rossmoyne, Shelley, Leeming, Applecross. One of the lowest performers has actually been Applecross. That's only grown 45% in the last 5 years, from 1.45 mil to 2.1 mil. The highest performing suburb, no surprises here, it's always been a high performer based on the massive push from the Chinese community for the school. Willerton, $730,000 as a median 5 years ago, has grown 75% to $1.28 million, a vacancy rate of 0.3% and a days on market of 9 days. Coastal North, now you think about Coast North, it's the Mullaloos, Callaroos, the Triggs North Beaches, all the way up to Burns Beach, Aluka. The high performer there, as I said, was Hillary's. The lowest performer in the area being Burns Beach itself, simply I think because it started at a relatively high space. All of these suburbs essentially north of North Beach are now right up there in the $1 to $2.5 million space. Trig being the most expensive with a 67% increase over that time to $2.4 million. Let's look at the western suburbs. Now the western suburbs is a unique market. It always has been. The lowest performing area in Western Australia over the last 5 years, simply because I think of affordability, but also somewhat diminishing amenity across some of these suburbs, like your Dalkeiths, for example. The best performing suburb in the area being Cott, with a 64% rise. The worst performer going across the railway line there being Peppy Grove, with a 42% rise. Now we're talking about suburbs with median house prices between 1.78 mil for West Leederville and 4.2 mil for Peppy Grove. So no one's complaining in these areas, but interesting to note that the suburbs with arbitrarily the most amenity generally in Western Australia have struggled the most when it comes to growth. Let's look at the hills. The hills have had an average of 54% growth over the last 5 years, underperforming the median over that time. The hills is obviously Gooseberry Hills, Darlington, Glen Forest, Kalamunda, Lesmurdy, these areas. The one thing to note about this area is that the growth across the board on these 8 suburbs in the $1 million space is pretty much the same, about 56 to 58% for most of them. Darlington was the worst performer with 51%, the best performer, Mundaring, with 58%. all of them just ticking over the $1 million space now. And it shows when the amenity is the same, the houses are the same, the median house price is pretty much the same as well. And lastly, let's look at the coastal south. The coastal south is a fairly unique market, not that many suburbs in it, to be frank. We're talking about Fremantle and surrounds. The best performer in that area being Coogee, $790,000 to 1.28 mil, and the worst performer being North Coogee with 56% growth, all very similar there at $1.64 million. Now, so it's pretty interesting to note there that the leaderboard there demonstrates that if you had property in the Middle Ring North area, Warwick and surrounds, you had property in the best performing area of Perth over the last 5 years. If you had property in the western suburbs, outside of Cottesloe, it was the worst performing area over the last 5 years. You can't complain though, we're talking about a range between 50 and 76% on your asset in the last 5 years. I thought it was interesting to note, I know I've gone quickly there, you could press rewind and go again, but the list is quite astounding when you look at best and worst performers in the $1 million space specifically. Now, quickly before I go, I wanted to talk to the general best performers over the last 5 years. You wouldn't be surprised to know that it has been absolutely dominated by the Armidale, Gosnells and Kwinana local government areas. In 5 years, the suburb of Armidale has won the game with a 5-year change of 120%. That means that it more than doubled in value over 5 years, from $265,000 in 2021 to $585,000 today. Its vacancy rate is 0.3% and it stays on market 7 days, one of the tightest in Western Australia. The list then goes on with Camillo, Brookdale, both in the LJ of Armidale, then Gosnells, Maddington, then Gosnells, Kelmscott, and then Belmont, the first one outside the southeast, being in the inner south, with a 91% growth. It's then Heathridge, Kewdale, Hillary's, rounding out the top 10. Hillary's, as I said before, at 87%, so the 10th best performing suburb in the last 5 years made 87%. Rounding out the top 20, Spearwood, Padbury, Hamersley, Rivervale, Willerton, Kingsley, Rockingham, Bedford, Bayswater and Madeley between 71% and 85% in that space. Some of the trends to note here is that most of these suburbs have increased in value for a couple of reasons. They are either really undervalued based on the replacement cost back in 2021 in the first place, and investors have noted the rental yields upwards of 6.5% and taken advantage of that, still in the 6% for some of these suburbs. They've been close to some great school areas, like Willerton, close to some great town centres, like your Belmonts, like your Padburys, Rockinghams, Bayswaters, these areas. They've been close to the ocean, like your Rockingham, Safety Bay, Hillary's, Heathridge's. As I always say, the main drivers of growth are generally proximity to the water, proximity to the city, proximity to good school zones and town centres. If you can get all four together, you're most likely doing very well for yourself. But the winner has been, over the last 5 years, the replacement cost inflation theory. Guys, that's a very fast monologue on where things are at right now in Western Australia. We've spoken about interest rates. We've spoken about the $1 Million Club and how there are 86 suburbs now when there were only 10 5 years ago in the first place. And we've just mentioned the top 20 performing suburbs over the last 5 years and their drivers as well. Where does the rest of 2026 look? As I've said at the wrap last year, we expect a lot of the same, to be frank. Some slight modulation with interest rates, but really if you're going to be experiencing continued demand through population growth from interstate and international migration above the amount of people we can actually house with new construction in the first place, and that deficit continues to grow, our median house price will continue to grow like Sydney's did until it starts to hit a cap of affordability like Sydney's has. It's hard to imagine, but don't forget, in 2008, Perth's median house price was higher than Sydney's. Have a great week. Look forward to speaking to you next Monday.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!